Coming up, we had some negative sentiment in terms of the consumer, and inflation expectations did rise once more to 7.3%, according to the University of Michigan's preliminary inflation expectations report. And is the stock market topping out? Has gold finally flipped bearish? And is oil primed for a major breakout? Stay tuned, all of this coming up in today's video. As we get started, if you could do me a big favor, make sure to hit the thumbs up button and subscribe if you're new. Let's talk some markets. So first of all, I want to start with actually the US dollar, which overall this week had a pretty boring mixed week. However, we've got some interesting stuff that occurred this week. In terms of inflation, we had CPI that came in better than expected or lower than expected for both the producer and consumer price index. This cooling off in inflation compared to forecasted numbers shows a bearish catalyst for the dollar index. Why? Because inflation coming down suggests that the Fed may be more willing to cut interest rates. We see pretty much a 70% chance by September we will have seen at least one rate cut, with a 20% or so probability of 2 rate cuts by that time. However, part of the reason the dollar index is rebounding is because of trade negotiations progressing in a positive manner. However, I don't know if it's all rainbows and sunshine from here. Europe wants more in the US trade deal than the UK or China got. There still seems to be a negotiation process that is ongoing and does continue to offer uncertainty to this market. And something big happened this morning with the put to call ratio. I noticed that for the first time in many months, we have reached extreme greed or a huge demand for call options in the options market. This is the first time we've had a contrarian bearish signal on the put to call ratio in several months, with the last several months when everybody was freaking out actually producing a wonderful contrarian bullish signal. We're now seeing some concerning evidence that people are starting to get more euphoric again on stocks. And I shared this exact chart and this explanation that I'm discussing in our free Telegram channel. And I do want to just remind you, if you have not joined it, it is completely free to join. It's in the description down below, linked for you. I'll also pin it in the comment section below. Again, we put out bonus clips from the streams and videos, chart markups each and every day, and of course, interesting finds that I have, like the put to call ratio today. So join the free Telegram channel if you have not already. Link is in the description. So with the put to call ratio leaning this way, I actually made some decisions here today in my own portfolio. Uber is a stock that I bought here this year in 2025, and I'm up pretty nicely on the position, a total of 36% or so. And I decided to sell a call at the $98 strike price, capping my upside, but potentially gaining some income in an environment where I think stocks are a bit overpriced now. I also did the same thing with my Nvidia position, starting to get a little bit stretched to the upside, so I decided to sell a 160 call out until mid-June. Now, all this does is it helps me to capture some premium in the meantime, and while I am cutting off my upside if the market were to completely parabolically rip, I'll also cap my downside a little bit by collecting some income for selling these calls. And I do want to be clear that I'm not necessarily thinking that the market is going to roll over and crash back down to the lows, but we've had an incredible one streak to the upside, and I do think we have some room to cool off. I'm not shorting this market, I'm just capping my upside slightly by selling calls. The equivalent of this would be to take some partial profits off the table, but I've chosen to just sell calls and keep my shares because I do think that there's a good chance that we do see some correction or some pullback within the next month or so. That being said, if we do get a corrective pullback, I will probably cover or buy back my calls that I shorted and look to get long more positions. Specifically, I really like the NASDAQ on the long side, the S&P 500 around 5,800, and of course the Dow Jones if we were to get a corrective pullback down to like 41,500 to 40,800, somewhere in this region, looks really attractive to me as a possible long side continuation play. And you can see things like the S&P 500 and the NASDAQ are flipping a little bit more, not necessarily bearish, but they're losing a little bit of their score simply because sentiment has now gotten a little bit euphoric. If we do get a correction, I imagine that likely the euphoria will wane off a little bit, it'll cool off, and then we can basically look from that perspective at a more centralized or decent risk reward. The problem is when everybody gets bullish or everyone gets bearish, the strong sentiment really reduces the risk to reward opportunities on charts that I'm looking at. To give you a visual of what I'm talking about, if I took a long trade right now chasing this market, the issue is I'd probably want to put my stop loss below market structure here around that support area that I've marked up. That's a pretty significant risk to take that trade in terms of a percentage distance. That's 8.5% on the NASDAQ. So when I look at it this way, I really don't like this risk to reward. And do I think we could go back to all all-time highs? I think there's a good chance that we do. However, I think that this risk-reward profile does not really attract me very much for a possible trade. Instead, if I drag this and keep my stop loss in the same spot, but wait for a pullback, you can see that the risk to reward profile looks a lot more attractive. So in this case, am I short the market? No. But if we do get a pullback, I'm way more interested in longs here because I think that the risk to reward is more attractive. Could this trade work out terribly? Sure. But at least I risked less and it met my criteria for an entry. So let's talk about the elephant in the room, which is this gold slide that we've been seeing recently. Yesterday, it looked like you had a pretty good bounce off of this area of support around the 3120 level, and it actually looked pretty convincing. If we scroll out and just take a look at the longer term chart here for a second, and we draw kind of a trend line across all this, you can see how pretty that level of support actually looks. The issue, however, is that we've lost some of the jet fuel that really got us into the stratosphere here, which was the trade war stuff, right? The concerns around China and the US not making a deal and everything's going to shut down and supply lines issues and all this stuff, right? People were flocking to gold to defend themselves. Now what we see is a bit of a double top formation with a break of structure here and actually retesting it. And depending on how this candle closes today, is going to be really interesting. If you do in fact get a strong closure at current levels or potentially even below that price, I would say be very careful with the price action of gold because yes, this is a strong overall upward trend, but as I've been discussing in my videos recently, we are still very far off from our next moving averages that many investors may be watching from a longer term basis. The 100-day moving average, which is this purple one, and the 200-day moving average, which is the yellow one. The issue here is that if we are in the process of retracing in a long-term uptrend, that could still mean 10% or so to the downside and still be in a context of a bull market, right? So again, I think this scenario is very possible with trade war concerns behind us. What it would take to get it back up here would be some sort of strong real world catalyst. Let's say that Ukraine and Russia negotiations break down. Or, for example, trade war stuff gets kicked up again. These would likely be the catalysts to coincide with price action reversing higher that I just don't think we're currently seeing. So the path of least resistance, in my opinion, is for price to continue to pull back or to trade sideways in the meantime. But it would take some sort of considerable catalyst to get us to break back through those all-time highs. So I'm neutral on gold, not short, not long, just watching it from the sidelines. Another setup I'm watching is US oil, which is getting a +7 score on the Edge Finder, with some of our economic data really pulling its weight. Retail sales coming in slightly better than expected, the overall services and manufacturing PMIs looked strong, and inflation data was pretty healthy, suggesting that we could see, again, some rebound in economic activity due to lower interest rates. Employment data was also upbeat, and so we're seeing some really good economic surprises that should help to buoy prices in oil. They already sort of have started, but what I'd be looking for specifically on a technical basis, I mapped this out on our live stream here today, which is this idea here. We have a key level of resistance looking at the 64 level. Can we get some sort of breakout of that key level and this long-term downward trend line for a possible bounce away and actually move back into the positive? With where we currently are, I do see limited downside for oil prices unless we were to enter into some sort of grand global recession, which I personally don't see as very likely at this time based on the economic data studies that I've been doing. However, things can change on a dime and something new could happen. COVID came out of nowhere and almost sent us into a multi-year global recession, but central banks printed a ton of money to save the day. So that's the question now with this situation with the trade war, seemingly the worst of it behind us. I actually think that the possibility for oil rebounding is quite high, and I really will be looking closely for these technical breakout trades to form. And today's video is sponsored by Vantage Markets. If you aren't trading with Vantage, check them out down below in the description. With Vantage, traders outside of the United States can trade CFDs, or contract for differences, on pretty much anything: gold, silver, Bitcoin, stocks, CFDs, all of that in one singular brokerage. They also offer a very generous welcome bonus to my subscribers. So if you'd like to take advantage of that welcome bonus and explore Vantage to see if it's right for you, make sure to use the specific link in my description to take advantage of that bonus while it still lasts. In today's episode of the Market Insights podcast with Johnny Hart, we discussed in detail the Michigan Consumer Sentiment Report that came out this morning, which I thought was really interesting. Take a listen.
Let's start with the first numbers that we saw today, which was the latest consumer sentiment data, which made interesting reading.
Yeah, it did. And the sentiment stuff, Johnny, in the recent months has been kind of an important one, right? People have kind of looked to it as as the soft data became very, very important to many market participants, because of course there's this thing here where the hard data of the past, with all of the changes made, became kind of less interesting, and more so the forward-looking quote unquote soft data, which is things like surveys and sentiment reports and inflation expectations. That stuff became very important. So this week we also got some of that. As you mentioned here this morning, we had the University of Michigan's preliminary consumer sentiment report. The actual number came in lower than forecasts, which is in line with, I guess, the recent trend that it has been going on, which is basically sentiment is in the dumps, people a little bit concerned in terms about what's going to happen next with trade and the dynamic of the economy that follows. So our forecast was for 53.1 in terms of the consumer sentiment report. We got 50.8, so came in a bit soft. And they also, just to add context, revised that previous number up slightly. So kind of a mixed response here in terms of the consumer sentiment report. At the same time, however, what might be just as interesting, if not more interesting, is the University of Michigan's inflation expectations, which previously were at 6.5. Previously were at 6.7%. They revised that down to 6.5%. But then the actual number came in a little bit higher. We had a 7.3% inflation expectation. And that's something to think about here. We've just kind of got to a point, I would say, where inflation seems to be on the way out, right? We're at 2.3% year over year on the CPI report that we got earlier this week, making some headway in terms of the inflation issue that has not just been in the U.S., but globally. We've made progress on that front. Oil prices are much lower than they were in 2022, and that has helped with the story. But this week, again, we saw more evidence of that with both the consumer price index and the producer price index, which shows wholesale prices coming down, suggesting that, again, inflation continues to moderate towards that 2% target. In that regard, I would say things are going pretty well. However, the challenge to all this is what happens next with the trade war stuff, because that's the big question mark for everyone, the Fed and everyone else, thinking about, hey, if we get a whole bunch of standstills in the trades, trade negotiations, if negotiations stall and are not quite, progressing any further, there is that possibility that tariffs, get reinstated, that these pauses are simply pauses, and then the drama starts up again.
I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.